3:30. I am Professor Nugent. This is Chapter 1, the role of financial manager. We have some learning goals here on Chapter 1 that we're going to review. So I want to define what is the financial management function. I want to talk about the goal of the firm, which is important to know for the simulation. The same goals of the firm that we talk about in the textbook are applicable to the simulation we're working with. Explain why maximization of the value of the firm is an appropriate goal for business. We're going to talk about activities of the financial manager. What do they do? I'm going to explain key principles and how the financial manager makes decisions. Different legal forms of businesses, different forms that businesses can take. And talk about the principal-agent relationship between owners of a corporation and various employees, government agencies, suppliers, different connections like that. So let's start with the very basic. What is finance? That's a good question, a fair question. And basically, it's not just the science of managing money, but it's also the art. So in finance, there is a lot of mathematical, data-oriented scientific approaches, but there's also a human connection, art to making decisions and deciding, intuition and experience to help propel the company forward. So at a personal level, finance is concerned with individual decisions about how much of the earnings you want to spend, how much you should save, where should you invest your savings. That's more on a personal financial nature. This class is not mostly about personal finance. It's 90% about corporate finance. But every once in a while, I'll sneak in some personal finance concepts or ideas that relate to the course material. So for a business context, it's quite different than a personal context. So this class is going to focus mostly on the business context of finance. So how do firms raise money from investors? What are different ways firms can raise money, which we call capital? How firms invest this money in an attempt to make more money. So when firms do raise money, have an IPO, sell bonds, and they get this capital, how can they use it to make more money? And the decision process to reinvest profits in the business or distribute them back to investors. So if the company actually makes money, should we reinvest it in the company or give it back to investors? So managerial finance is really about what are the duties and responsibilities of a financial manager in a business. In the simulation, you're going to be everyone on your team is a financial manager running a business. And it's going to parallel the same concepts and ideas and goals as the textbook. So what is a firm? A firm is a business organization. It's the purpose of it is to sell some sort of goods or services to make a profit. And firms exist to enhance the economy. They exist because investors want opportunities to invest their money and get better returns in the bank account. So there's capital that investors have, and there's ideas and companies that people want to start. So the two of them get together, and businesses begin. Now, what is the goal of a firm? Now, we're not talking about non-for-profits, like a school or a church, those organizations. We're going to pretend, for the most part, when I'm talking about this textbook, that non-for-profits are not part of this world. We're focusing on the for-profit world of business. And most businesses are for-profit. So the goal is to maximize shareholders' wealth, which means make money for the owners. So the goal of the business is to make money for the owners. It's not that's the main goal of the business. So people don't start firms or go into business without the concept of this business needs to maintain profitability if it's going to be alive. Profitability is the life force of a business, and when they're not profitable, that could lead to default, which leads to bankruptcy, which is the death of the business. So that's why businesses must focus on staying solvent and profitable. So managers need to do everything they can to maximize that wealth. And I talked a little bit about that in the introductory session of the class, where every penny matters every cost that you can reduce, you should try to reduce. If you can raise prices, you should try to raise prices. If it fits your strategy, if you can make more money. Sometimes raising prices, you make less money because the products are too expensive. Sometimes you could raise prices and then the products still sell because they're that good and people are willing to pay for them because there's a value there. So for most companies that are public, maximizing the stock price is a reflection of maximizing profitabilities. If the company maximizes profitabilities, the stock price should follow. So typically companies that are the most profitable have the highest stock prices. Now, does profit maximization always lead to the highest possible share price? Most of the time. Sometimes companies might be valued more on their growth of sales. So sometimes if it's a new company, like an Uber or a Lyft, they might be more interested not so much in profits right now, but the speed at which the company grows its revenues, with the intent that those revenues will turn to profits soon enough. Amazon was unprofitable for many years before it turned a profit, but it had a very high stock price because people anticipated the company was going to generate massive amounts of profits, which it eventually did. Now, for at least 3 reasons, the answer could be no. Timing, cash flows, and risk. So these are things when you're thinking about a startup, the timing of when you don't want to sacrifice potential sales because you're too worried about profits. Sometimes you need to be more in an investment phase, a growth phase, where you know profits may suffer a little bit, but you're using this to grow your market to become more profitable in the future. So the timing of these cash flows, but if the company focuses on profit maximization to a point where it's greatly going to increase the risks of the company, say, for example, McDonald's decided, let's try to make more money by going into the phone business and making smartphones, because there's a lot of money there, you can see that's going to raise the risk of investors in McDonald's who are used to a pretty safe return. So the stock price could go down if they start moving into an area that they're not so proficient in. So there's some gray areas here. But by and large, the company exists to do everything possible to maximize the wealth of the shareholders, which means make a great product at a low cost and sell it at a high price as best you can. And while what makes that difficult is when you're trying to fight competition. So let me give you an example here. So this is a marine engine components we're talking about, and choose between 2 investments. So we're talking about they can invest in the rotor or invest in the valve. So here the earnings per share breakdown on each of these different businesses. Okay, so you can see that year 1, 2, and 3. Year 1, the rotor is better than the valve as far as contributions to earnings per share. Year 2, they're even. Year 3, the valve is contributing more than the rotor. The totals are $2.80 and $3 of earnings per share of those 2. Okay, so when you look at this, which should it choose if it only could choose one? Because I would say choose both, but if they could only choose one, which would be better? The one that had $3 earnings per share or the one that had $2.80 per earnings per share? So the idea here is you might say the $3, because that's higher earnings per share, but the $2.80 should be considered because you get more of the money up front faster. So the $2.80 here, you get the $1.40 in year 1 and 40 cents in year 3. So getting money sooner is better than later, because you could invest that $1.40 in year 1 and make that grow fast for you on some other projects. So the timing of these cash flows would say, even though this produces more of a cash flow, this produces cash more up front. It's sort of like, do you want to, if you had the choice, would you like to have, say you're an employee, you work for a company, and they give you a choice. We could pay you your full salary January 1st, $60,000 for the full year on January 1st, or we can pay you at the end of the year, December 31st, and we'll pay you, instead of $60,000, we'll give you $63,000 because it's at the end of the year. Which would you rather have? I think most of us would say, I'll take the $60,000 right now because that's more valuable to me than $63,000 a year from now at the end of the full work year. Because I can take that $60,000 and invest it in stocks and maybe double it. So timing of the cash flow is important. Okay. So remember, the goal of the firm is to maximize shareholders' wealth. But we have to also, we can't just maximize shareholders' wealth and commit crimes and be unethical. If I murder the head of my competition, that will, disable their company and I'll be able to be more profitable. That's unethical. So the consideration of the welfare of the stakeholders, the shareholders, not just the shareholders, but the stakeholders. The stakeholders are the employees. They could be the customers. They could be the suppliers and vendors. They could be the world in general. So you don't want to be a company that's doing something that's taking advantage of their employees by maybe paying them a low wage or not providing them benefits or doing something that would not be in the employee's best interest. So there becomes a balance where you do want to maximize shareholders' wealth, but you don't want to abuse your stakeholders and be unfair to them in an effort just to maximize your profits. Because then your stakeholders will start to not like your company, employees will start to have lower morale, customers may not repeat buy your products. So there is a trade-off. You can't just be ruthless and unethical. You have to do things in a way that's balanced so that you're maximizing shareholders' wealth, but you're also taking care of your shareholders, your stakeholders at the same time. So companies that do very well, they should give their employees raises and give them the ability to be promoted and things of that nature. Okay. So if you neglect the so here are some flaws if you're neglecting shareholder wealth maximization. So as I was saying before, that you can't ignore the interests of other people connected to the firm, the stakeholders, because there could be other consequences that will affect your company later down the line. So to maximize shareholders' value, managers must look at the long-term consequences. So, for example, British Petroleum decided that it would be a good financial decision to meet the minimum requirements of safety in their offshore oil rigs in the Gulf of Mexico. So we're meeting all the federal requirements, but we're not spending the extra money to get the even better, safer equipment for these offshore drilling facilities. Then you have the disaster that was at the Horizon? I forgot the name, but there's a platform, there's a movie about it starring Mark Wahlberg, that the oil line at the bottom of the Gulf broke and tons and barrels and barrels and barrels of oil leaked into the Gulf of Mexico, costing British Petroleum billions and billions of dollars of penalties and fines and cleanup costs. So this was a sense where, okay, yeah, we took the basic minimum safety requirements for these oil rigs, but we wound up paying much more at the end from all this loss of oil and damage to the environment that we had to clean up and pay back to people. So sometimes if you're thinking about long-term consequences, you may want to pay the extra money for the extra safety features or the extra security. So it's difficult for managers always to make the best decision that's going to lead to the stakeholders and the shareholders being satisfied. But if they typically have a longer-term approach on how to carry out the profit maximization with considerations of possible problems in implementation of some of these new businesses or new ideas or new concepts as far as how they impact on stakeholders and suppliers. Now, citizens of the world are stakeholders. So if a company decides, let's use coal to generate all the energy to build our products, or let's make a car that runs on coal because it's going to be cheaper for the consumer and easier for us to make the car, that's not good for the global climate, the climate disaster that we're facing. So that way you're not taking the stakeholders, which would be the citizens of the earth, and that could lead to a backlash of your company being viewed as a non-green, non-planet-friendly company, which means consumers will be less compelled to buy your products if they think you're hurting the planet. That's why so many companies want to appear as a green-oriented company. And British Petroleum put a lot of money in advertisements to advertise, we're investing in solar, we're investing in alternative energies, to kind of hide all their dirty energy companies where they make all their money, to foster or talk about a greener side of the company, because that is trying to connect more with the citizens of the world. Whether or not they really mean to foster green energies and green energy production, it seems counterintuitive because it comes at the cost of all their investments in gas and oil. Now, you don't want to neglect the shareholders, because the shareholders vote on the board of directors. The board of directors hire the management. So if you neglect the shareholders, if you don't maximize their wealth, they can have you fired as a manager. So managers need to keep in mind that the shareholders, which we call, they're the people who own the stock, that really own the company. If you do things that are not in their interest, or they see you as not maximizing the wealth of the company, then they're going to take action to remove you. And if you do things that are unethical or illegal, that's going to be grounds for removal too. So financial managers have to be very cautious that the decisions they're making are not just ethical, but also legal, and also in the shareholders' best interest of maximizing wealth if they want to keep their job long term. When they mess up on this, they're fired. So the role of ethics becomes a pretty, in this day and age, the role of ethics for financial managers is a very high standard they must maintain. And certain regulations have been passed over the years to hold them more accountable for some of their decisions. So if they make financially oriented decisions that can harm people or harm the company, then that's unethical. And if you take a company like Juul vaping company, and they were looked at promoting, advertising, and promoting the use of vaping products to underage people, that would be seen as unethical and could foster and encourage the government to pass regulations and against the company, or even penalties by inflicting health-related problems on the underage population who aren't of age to make a thorough decision on whether or not they should vape. So that company's share price, or not share price, the company's value has gone down dramatically once these allegations have become exposed to the general public, and especially since the health hazards of some people dying of vape-related incidents, most of them not related to Juul products, but you'll see it puts a dark cloud over the industry. So that's bad for the management of that company, and I believe some of them did have to step down over that. So there are these ethical guidelines that you as potential financial managers or managers in general need to think about. So does the statute make unfairly single out an individual or a group? So if you make a decision, we are not going to sell this product to these group of people, or we are going to, there was a big controversy over Chick-fil-A and their policies of, that's a privately owned business, but they had policies of contributing to organizations that singled out the LGBT community, that we were against the LGBT community. So posters and campaigns started going up where, they have that cow that says, tastes like chicken, and they scratched out chicken and said, tastes like hate. So there was a really negative backlash, not just from LGBTQ people, but from people who are allies or supported them, saying, hey, this isn't right. You shouldn't be funding these things. And the company took a back step and said, okay, we're not funding them anymore. We secretly are, but we're not funding them. Officially, we're not funding them, but they probably still are somehow. But publicly, we're not funding them because we don't want to lose your business. We want you to keep, unless it's Sunday, then we don't want your business. But the rest of the week, we want to welcome everybody. We don't want to hurt our business by our charitable gifts to organizations that might promote hate or single out individuals or groups. So there's an example where they should have thought a little bit more closely about how their businesses were tied to their contributions to charitable organizations if those charitable organizations were not ones everybody found to be ethical. Does the action violate the morale or legal rights of any groups or individuals? Meaning that if you say, we refuse to sell birthday cakes to Irish people, kind of a right to be able to buy a birthday cake, right? You know, you shouldn't single out a group of people because they're Irish and tell them they can't have their birthday cakes. That's an extreme example. Sometimes I need to go that extreme to get your attention. But that would be something that might not be what we call a morally competent argument. And it may be impeding the rights of these people to single them out in that way. Does the action conform to acceptable moral standards? So that might fit more into that category. That we have, as a society, we have certain moral standards, you know, that we adhere to keep our society civilized. So if a company does something that would be like, this week with our Happy Meal, we're going to include a toy called Bag of Glass. And this bag of glass is really fun for children to play with. Morally, we don't like toys that are hazardous to children. And a bag of glass, which you may not know is an old Saturday Night Live skit with Dan Aykroyd, is not really a safe product. And we go against our moral concept of making products that are safe for children. There's a common product that's sold in most countries. It's a chocolate egg with a toy inside. They don't sell it here because they think it would cause children to choke because I guess American children aren't smart enough not to eat the toy. But I see these, they're sold in Europe and all across the world. They're like this egg, it's chocolate outside, a little toy inside, but they have, you know, companies are afraid to sell it here. Our alternative course is the action that are less likely to cause actual or potential harm, meaning that don't go to the cheapest way of doing something if that may actually cause harm to people. Maybe there's an ingredient that you're going to put in your food that maybe could cause a lot of allergies or kill people, a peanut allergy maybe. Maybe there's an alternate ingredient you can include. There was, I remember there was, I was watching some show, I think it was on Netflix, and there some a girl had a peanut allergy, and she went to a Thai food restaurant, and she said, I have a peanut allergy, I want to order something that's nut-free, and they said, oh, this is nut-free, you'll be fine, and then she almost died. And what they found out is they switched from a neutral oil, like a vegetable oil, to a peanut oil because it was cheaper of some such nature, and then they didn't disclose it, and the restaurant got in big trouble. I think it was a restaurant in Vancouver. But you see, that's unethical to switch the oil to an oil people are allergic to just to save money, but then not even fairly disclose it to people. So there's a role of ethics and share price. So if your company is known to be very ethical, that can enhance the feelings people have about the company. They feel good about the company. They want to participate with the company. So it leads to positive benefits. Ethical behavior, incorporated into the goal of maximizing shareholders' wealth is what keeps companies safe. So you don't want to, for a while Google had a slogan of do no evil. And a lot of people were pro-Google. Google's a great company. I want to buy their products. I want to be involved in the Googleverse. And then certain facts started coming out about them tracking your movements and tracking your clicks and advertising specifically to you. And so there's been some questions about, is Google as ethical as we thought they were by them telling us they're not doing any evil? Are they maybe doing evil? Is our privacy at stake? Are they selling all our data to advertisers without our knowledge, such as what Facebook did with that whole scandal not so long ago? So these are things that when companies start becoming perceived as more unethical, like Facebook, then that might reduce participation in its products, which is not good for maximizing shareholders' wealth. So let's switch over. Let's get away from ethics, enough of that ethics, and we'll move over to just managerial financial functions of managers. So some key decisions you have to make. Investment decisions. So as a financial manager, you have to decide where's the company going to make investments with the capital that they have. And that's what the capital budgeting decisions come up, something we're going to talk about in Chapter 10. And capital budgeting is a more formalized budgeting of this money for investments. And so some of these financing decisions, the capital structure decisions, which we can talk about in Chapter 9, how much money should we raise from stock, how much money should we raise from debt, and working capital decisions. What are we going to do with our short-term resources, and how are we going to engage that in the working capital of the company? If we look at this diagram here, we see a balance sheet contains assets and liabilities. So the investment decisions fall within the asset area. Short-term and long-term. Current assets are like cash and inventory. Fixed assets are like equipment and buildings. And then financing decisions take in this area of current and long-term liabilities. So these are financing. Should we borrow from a bank? Should we borrow from a short-term loan? Should we borrow from, set up a long-term mortgage, a long-term bond? These are different financing activities that the financial manager engages in. Other decisions that help guide the financial manager is time value of money. Knowing the value of money as it moves through time, something we're looking at in Chapter 5. The risk and return trade-off, something I think Chapter 6 we're going to talk about. If we're going to make a risky move to get a higher return, is it worth it? Are investors comfortable with that? And even a company like McDonald's, they did take some risks. They invested in and purchased Boston Market, which they later sold. They had investments in Chipotle Mexican Grill, which they later sold, because they found that at various times the money would be better reinvested in McDonald's rather than these side businesses, because it was a lower risk to expand the McDonald's brand and the McDonald's offerings under that umbrella rather than open other or maintain other fast food franchises. Managing cash. We often say cash is king, especially if cash is the oil of a company. What happens to your engine if all the oil leaks out of it? It seizes and your car is ruined. If a company runs out of cash, they seize, they go bankrupt, the company's over. So we have to always maintain our cash and make sure that we're competitive in the financial markets as far as getting the best rates of interest and return on whatever we're financing or borrowing from. So incentives for a financial manager are important as far as how do you want, this is part of this principal agency problem. So we want to make managers, incentivize them to maximize the shareholders' wealth. And we can do that by giving them stock options, giving them bonuses and raises based on performance. So this encourages managers to work longer, work harder, hopefully make better decisions, and escalate the revenues and the profits of the organizations, because they're going to be rewarded for doing this. One issue may arise when the rewards are so generous that they might make decisions that are short-term or not in the company's best long-term profit forecast, so they can get short-term gains for themselves. And that's more of an agency problem, where the managers then managers are not the same people, and they're agents of the owner. So they need to act in the interest of the principal. So the principal is the owner. So there's a problem when the agent does not protect the principal. For example, some of you may have worked. So if you're working a job, say when I was in college, I managed a chain of movie theaters, and I would keep a keen eye out for people who were stealing. And there were a lot of cheats and thieves among the 16 to 18-year-old group of people we employed. They would do things like boyfriend and girlfriend. The girlfriend would sell the tickets at the box office. The boyfriend would palm the tickets, give it back to the girl. She'd resell them and keep the money. We had one gentleman who would go into the theater, find some cups, empty them out, and resell them and keep the money. Reselling used drink cups, used popcorn cups, because that's how we would keep the inventory. So we'd say, okay, we started with 100 cups, we now have 50 cups, we must have sold 50 cups. So if he takes 5 cups from the theater, used out of the trash, and resells them, doesn't punch them into the cash register, he keeps the money. So you see how this is the interest of the person, the employee who's an agent, not the owner, the principal. They're stealing from the owner. So we want to make sure that the firm is organized in a way that prevents this agency problem where people are not doing what's in best interest. Sometimes it can be small things like, oh, I start the day off with a cup of coffee and a good half an hour of Instagram. Followed by a half an hour of Facebook, a half an hour of talking, a half an hour of snack, and then I get to work around 11 o'clock and take my lunch at 12:30. See how you're getting paid hourly to do a job, but you're not producing. You're wasting your time playing games, playing Facebook, talking to other people. This is unethical behavior, and it's not what the principal hired you for. So it could be small things like that, or big things where thousands of dollars are stolen or misappropriated. Or, for example, ever watch that show Friends? It's a big show for your generation, according to Netflix. On that show, there's an episode where Monica gets fired because she received steaks from a vendor. So she received these very expensive steaks from a vendor, which is a no-no because you shouldn't accept gifts from a vendor because that means you may favor that vendor. So if that vendor, you have higher prices, you have lower prices, but you give me steaks, we're buying from you because it's not my money, it's the company's money, but I'm getting free steaks. So you see how that's a conflict of interest? So you can learn a lot from Friends. That's why the show's so popular. Moving on, managerial finance function. So the organization of the finance function. We have the CEO, Chief Executive Officer, sometimes called the president of a company. So that's the big person in charge. Okay. Beneath them would be the CFO or the Vice President of Finance, Chief Financial Officer. And the CFO or Vice President of Finance, depending on how the company is organized, they're going to either do these functions themselves directly for a small company or hire people to do these functions. So you can have a treasurer that deals with the cash of the company, a controller who deals with the accounting of the company, director of investment relations, director of internal audit, foreign exchange manager. So these are all people or functions that report to the CFO. So these are all things that companies, usually mid-size or large companies, definitely need to be involved with and have to be done in a way that's going to maximize shareholders' wealth. In this diagram, what takes us from the stockholders will elect the board of directors. So the stockholders have voting rights in the shares of stock. They will elect the board of directors. So this board of directors will then, in turn, elect a president or CEO. The CEO will then, in turn, hire a chief financial officer or the VP of finance. And these are the roles that the VP of finance will staff. And underneath, the controller, you'll have a cost accountant, financial manager. You'll have an assistant controller. Under the treasurer, you may have a cash manager, director of tax, foreign exchange manager, director of risk management, things of this nature. So there's a whole host of people that will report to the CFO. These other areas, human resources, operations, marketing, and technology really don't matter. I'm kidding, of course. When students had a sense of humor, they used to laugh at that. Now, the managerial finance function, relationship to economics. Some of you may be economics majors or have an interest in economics or economics minors. I don't think they have a minor, though. Anyway, there's a relationship between economics and finance that's pretty close. So it's often good that a financial manager has an economics background. Economic principles are closely tied to financial decisions. So we might look at things at marginal benefits exceeding marginal costs. And we'll explain that in a minute. but some basic financial concepts that so we'll tie the marginal benefits to sales and the marginal costs to the cost of products in a minute. But let's look at, first let's go back to the relationship to accounting. So accounting is it's almost like it's a set of rules, like law. So there's a defined set of rules of what companies can do and how they record their business activities. So there's an accrual base and a cash base. So an accrual base recognizes the revenue at the time of the sale and recognizes the expenses when they are incurred. Where a cash basis recognizes the revenues and expenses only with respect to the actual cash flows. So it's possible in the accrual basis to sell something and record the sale and record the profit, but never actually get paid for the sale. And the cash basis, you will only recognize the revenue once the cash is collected and the expenses are paid, thereby your profit is different in the timing of which you look at it. So in the decision making, a lot of accountants are going to devote their attention to the collection and presentation of financial data. So when I worked as an accountant, when people would ask me, they would say, wow, you must be really great at math. I'm like, yeah, I'm really great at adding, dividing, multiplying, subtracting, because that's about all the math you do in accounting. And that's basically true. So in finance, that's when you get to the high quantitative finance, a much higher math in finance than accounting. Accounting is really just kind of record keeping. And it's sort of like doing laundry. So the accounting would be, okay, I got to separate the debits and credits, the whites from the dark wash, and then I got to, when I do the whitewash, I got to add Clorox and a special cleaning, and then I got to dry it. When I do the dark clothes, I don't add Clorox, maybe I add fabric softener and a different type of detergent, and then some things get dried in the dryer, some things get hung dry, some things get dried on low, some things get dried on high, and then I take this laundry, I fold it a certain way, I place it in certain shelves or certain drawers in the dresser, and I'm done. One day or Sunday comes back, another pile of laundry to do, and you repeat the process again the next week or every day. So accounting is a repetitive, attention-oriented collection and organization of financial data points. Now, financial managers take this information that the accountants have put together, the financial statements, and they're going to evaluate the financial data and make decisions. So accountants are going to put together, take the rules of accounting and ultimately build them up into the balance sheet, income statement, and statement of cash flows. The financial managers are going to take these statements, convert them into ratios, do some additional data development on this, and make some decisions based on the risks and returns of this information. Are sales going up? Are sales going down? Are profits going up? Are profits going down? Are certain countries doing well? Certain countries not doing well? We get all this information from accounting. Financial managers look at this information and make decisions. Okay, we need to pull out of Mexico and we need to pull out of Canada but set up operations in Brazil because Brazil is booming. We're making lots of profits. We're not doing well in Mexico. Let's put some more advertising and some more effort into our German area of our location. So all these decisions financial people make based on the information accountants provide them. So accountants provide, here's the organized, cleaned and organized and properly stored information about the company. Financial managers take this, analyze it, interpret it, make decisions moving forward to where the company should go. Should we divest, sell a division? Should we buy another division? Should we, start new products? This is what financial managers start to look at based on the decisions. These decisions are made based on the information accounting provides. But just getting back to the economics, where accountants may look more of a accrual basis, check, product's been sold, these are our expenses, this is our contribution to profit, even though we may not have collected the money yet. Financial people really look at, okay, at the end of the day, we sold it, did they pay us for it? Okay, well that's real profit. So finance people are real concerned with real cash flow, real profit. and accounting people are just concerned with, recording the events. Okay, let's go to legal forms of business. Now, we have the sole proprietorship. This is great for people who like to work alone. People who hate teams, people who don't like to work with other people like to be their own boss and have no one to answer to and no one to talk to. The sole proprietorship is a perfect business setup. I'm exaggerating a little bit just to get your interest, but when you start a sole proprietorship, it's the easiest form of business to start, because basically you just decide, I want to be in business, and you're a sole proprietor. Now, there are a couple negative or downsides to this that we'll talk about. One of the big ones is unlimited liability. So you become a sole proprietor, you want to own a juice bar. So this is a bar that you juice to make people healthy, but you decide to, for some reason, you decide to include motor oil in your smoothies, thinking that motor oil is good for people. It's good for cars, probably good for people, because you're not too swift. You wind up poisoning a bunch of people, they sue you, they can take everything you've got, your business, your house, your car, your bank accounts, everything. Because you have unlimited liability as a sole proprietorship, you don't have much protection. So that's why oftentimes sole proprietors will load up on insurance to help mitigate the unlimited liabilities they have to creditors, to people they do business with, to their employees. If once all the business assets are depleted, they'll go after their personal assets. So that's a real drawback of a sole proprietorship. There are others we'll talk about in a few minutes, but a partnership is when two or more people get together and say, let's make a baby. No, wait, that's a marriage. A partnership is two people get together and say, let's operate a business and make some profit. And it could be more than two people. It could be, unlike a marriage, it could be 3 people or 4 people or 5 people. Imagine a 5-person marriage. That would be pretty confusing. But in businesses, it's allowed. So you make an articles of partnership and you state each partner's responsibilities, each partner's what percentage of the company do they own, what percentage of the profits do they get, so they make it establish sort of a contract. And what's great about a partnership is that you have more people to help you with your business, more talent. So maybe one person's good at accounting, one person's good at marketing, somebody else has a lot of money to bring to the company. They're not good at anything, but they have $1 million to give to the company, so they're a partner now. Maybe somebody else is just good at designing products. So you work together as a team, much like you're going to do in the simulation. So when you work that simulation, working together as a team will help sort of that expression, 2 brains are better than 1, or 3 brains, 4 brains. The more eyeballs you have looking at it, offering advice, testing out things, working together, the higher you perform. And that's what makes partnerships pretty good. But they still have unlimited liability. So they still don't have protection of their personal assets as much. Corporations are another form of business that you most likely have heard of. Now, this is basically what we're doing is we're creating an artificial person. So partnerships and sole proprietorships end when someone dies. The business is over. A corporation, being a artificial person, can live forever. So corporations can live forever, which is great. Because if the principal owners die, the corporation can live on. It doesn't end like a sole proprietorship when the principal owner dies. So the stockholders are really the owners of the company. So those are represented by shares of stock that individual people purchase. So you can have, whoever has the majority of that stock will have the controlling ownership of the business. Now, the corporation has limited liability. So if the corporation does terrible things and gets sued, only the assets of the corporation can be consumed, not the assets of the shareholders. So if I own a share of stock in a company and that company winds up, was a chemical company and they had a chemical release and wound up killing a whole village of people, which has happened in the past, as a shareholder, I'm not going to be legally responsible for that horrible event. The company will, and the company could lose all their assets, but they can't attack my personal assets. So that's a real bonus of being a company. Let me just see something here. Okay. So moving forward with, this is the same slide. All right. Okay. So stock. So like I was saying before, stock represents ownership in the corporation. And the way corporations pay back stockholders is they give them dividends. So if the company is doing very well, then their shareholder, the managers and the board of directors will come together and they'll propose a dividend. And then if you own one share of stock and it pays $1 dividend, you've got $1. So that's how you get rewarded for owning stock in the company. Now you also get rewarded by the stock price going higher. So if the managers maximize shareholders' wealth, they maximize revenues, share prices should go higher. And then if you own a share of stock and you bought it at $10 and now it's $100, you're doing very well. If you bought a share of AutoZone at $50 and now it's $1,800, you're doing very well as a shareholder. Now, the board of directors, the shareholders will vote and elect the board of directors. So the board of directors are like this group of elders who are going to guide the company and going to hire the management to run the company. And they're going to be responsible for for approving strategic plans of the management. So they're basically this voting body that's going to double check the management. So the management will have to, certain things they'll have to approve through the board as far as strategic goals and plans, general policy, corporate affairs, making major purchases sometimes. So depending on how involved the board is, some companies are greatly involved, some companies are less involved, but basically the board of directors is going to help counterbalance the management to make sure that the company is on track to maximize shareholders' wealth. Now, the president or chief executive officer, this is someone who is going to be, of course, hired by the board of directors. And the board of directors, they don't work full-time for the company. They're often very limited in the amount of time that they give to the company. They're not full-time positions, mostly. So they have to hire full-time people to run all the day-to-day business operations of the company. So they start with the CEO, and he's responsible for the entire operations, all the day-to-day decisions, and the CEO will hire other managers to run the company to help facilitate all these decisions and get the products made out the door and collect the profits. And so now if the board of directors doesn't like the CEO, they can fire him and replace him or her at a later date. So let's kind of recap. This is a nice slide. Great for studying for the test, wink, wink. Summarizing a lot of these points. So let's just go over it again. Sole proprietorship, you're as an owner, what's great about sole proprietorship is you are going to receive all the money. That's really good. So if I was going to invent an engine that runs on seawater, I would want to be the sole proprietor of that business so I could collect. Let me adjust this chair. This is defective. Some of them go up higher, but rather than sharing that with partners or a corporation, I'd rather be the sole proprietorship and receive all the profits. So if I had developed a machine that turns soil into gold, I would want to be a sole proprietor. I would not want to share that, because I could keep all the money to myself. Low organizational costs as far as the setup and design and applications for the organization. The income is taxed at your own personal tax rate, which, if you're at a high tax rate as an individual, you may pay more taxes on this. But you can be independent, you can be secretive, and you can stop the business at any time to say, I'm done, and walk away. The partnership, some advantages or strengths of the partnership is that you could raise more funds. So if you're a partnership and you go to a bank and there's 5 people in your business, the bank's going to be more willing to lend you money because it's not just dependent on one person. And these 5 people could also bring their own money or their own contacts, friends and family to help fund the business as well. So the borrowing of the company and the contribution of funds is more substantial with a partnership. There's more brain power, more managerial skill, the more people you have on board, the more talent, and the more, just more hands on deck to get the company going. But that can be a double-edged sword, though, because it could be more disagreements, more time-consuming discussions to figure out what you're going to eventually do. Income from a partnership is also taxed at a personal level. Now, with a corporation, what's the best advantage of the corporation is you have limited liability. So you can't personally be sued for problems the corporation may have that's going to give people legitimate access to their assets. You can achieve a much larger size as a corporation. The corporation can live forever. Stock in a corporation is easily transferable and sold to the public on exchanges. You can hire professional managers, and you have much better access to financing as a corporation. Let's look at some of the weaknesses on the other side. And this is why generally some companies may start out as a sole proprietorship, evolve into a partnership, and eventually apply to be a corporation when they get big enough. So a lot of times this really depends on the size of the business. Most small businesses probably makes most sense to stay as a sole proprietorship or a partnership. As the companies become bigger, they become bigger targets. You know, for example, you hear about these famous people. It's hard being famous because you start developing a lot of lawsuits. People want to sue you, or people want to stalk you, or so the bigger you get, the more problems you have, and the same thing for businesses. The bigger a business gets, the bigger target it becomes from potential lawsuits for just frivolous lawsuits against the company, just for people trying to raise money. So again, the sole proprietorship, you have that unlimited liability, so your personal wealth can be attacked. You have a limited ability to raise funds. And as a sole proprietor, you have to be prepared to do everything until you have enough money to maybe pay some people to help do some of the work. But in the beginning, you have to be a jack of all trades. So you might be filing your taxes, you might be developing your sales plan, you might be actually making the product. Sole proprietors have a difficult time attracting employees or giving any type of long-term potential benefits or career. And when the owner dies, the business is done. For a partnership, you still have that unlimited liability, and the partnership will end when one of the partner dies. So it's a little difficult to transfer ownership or liquidate a partnership because all parties must agree. Now, the corporation, the big drawback or weakness of a corporation is that taxes are generally higher because income tax is double taxed. So let me explain how this works. The company makes money, and they pay tax to the federal government based on the money the company made. The company then turns what's left over, they may pay as a dividend to shareholders. Shareholders receive the dividend, then the shareholders have to pay tax on the income also. So when you're a shareholder or owner of a company, there's double taxation. First, the company pays tax, and then you pay tax. So that's a big drawback of companies. It's much more expensive to own and operate and run a corporation than a small business or a partnership. They're subject to much more greater government regulations. They lack secrecy, especially if you're a public company. If you're a public company, the cost of running a business goes up by a great deal. The amount of government regulations and scrutiny goes up, and the amount of the lack of secrecy and privacy it becomes a big factor. Everything has to be disclosed. So it's not like a private family company where you can keep your revenues and your profits private. Once you're public, everybody knows everything about your business. So in the simulation you're running, those are going to be public companies where you can look at the other companies in your industry, other student teams, and see what their sales are, their profits, how they're making their cars. Full disclosure. Okay. Okay, so let's talk about how these types of businesses break down. So, do I have a, this is a lot of words here. This is a wall of words. This I like to slide better. So let's look at, in the United States, there are 25 million sole proprietorships, 3 million partnerships, 6 million corporations. Percentage of all companies, this is 73% of companies, 10% of partnerships, 17% are corporations. So why are so many companies sole proprietorships? Because there's a lot of small businesses. You go walk down the street, the nail shop's a small business, the deli, the pizza store, these are all small businesses. And there are many small businesses because it's just easy to start. Some of you might be small business owners. You might be, you might have your own business working in selling some sort of products on eBay, or what's that site where you do art, you sell, is it Etsy? So there's ways of you becoming a small business that's very simple. So that's why there's a lot of them. Now, as far as the amount of income they generate, all these small businesses only generate about 10% of the income. The partnerships generate about 26% of the total income in the country, but corporations generate 64%. So even though they're only 17% of all firms, they're generating 64% of all income. So corporations are big, they generate more money. It makes sense. Okay. So as far as taxation goes, if it's a pass-through business, businesses such as sole proprietorships and partnerships, they're taxed at an individual rate. That's what's called pass-through. Some of the new tax laws have changed how this is taxed. But basically, whatever money you make in the business gets added to your personal income. So when you file your taxes, it gets added on top of any other income you have. So it's taxed at a personal level, using personal tax brackets. Now, when we're talking about tax, there are two things called marginal and average. So, an average tax could just be looked at as, say you paid $5,000 in taxes and you made $20,000. So how much is your average tax rate? It's 25%. 5 divided by 25%. That's just an average. Marginal, the way that the taxes work in the country is of a marginal nature. Oh, where was I? Sorry about that. Yeah, marginal. So it's sort of like in steps. So the first, these are all numbers I'm making up. They're not 100% accurate. So the first $10,000 you make, you get taxed at 20%. The next $10,000 you make up to $20,000, you might be taxed at 15%. The next money you make from $20,000 to say $50,000, you're taxed at 22%. And then, so every time you make more and more money, your tax rate on the new money goes higher. So even though you paid 10% in the first $10,000 you made, any money you make above that, you're going to be paying 15% tax on that new money. So as you make more money, you pay higher taxes. So if you're in the 35% tax bracket, you did not pay 35% of all the money you earned. That's just the new money you're making, you're paying 35% on. So it sort of increases the more money you make. And that's why they call it marginal, because it depends on where you left off. If you left off in the 38% tax bracket, any new money you're going to be making is going to be paid at 38%. So if you average all those tax brackets together, you get your average rate. So that's why that we break this out. Now, as far as business organizations, there's what we call double taxation. So you get taxed twice, which I explained before. The company pays tax on their income. They pay owners a dividend, and then that dividend has to be paid. Owners have to pay the dividend, tax on that dividend. That's why a lot of stock shareholders don't want dividends. They'll say, don't pay me a dividend because I'm going to have to pay 40% tax on that, state and federal together. I'd rather you take that money and reinvest it in the company and get that stock price higher. So don't give me all the profits you make. Take those profits and buy another business or expand the business and make the stock go higher. And then later on, because I don't pay tax if the stock price goes up, only when I sell the stock. So if I own a share of stock that goes from $10 to $40, I'm not paying any taxes until I actually sell that stock. It's called a realized capital gains. So that brings us to our next ordinary income versus capital gains. Okay, so if you're just a person who goes to work and makes a paycheck, we're going to call you a basic worker, an ordinary worker, a basic B, basic business person, right? So that's what ordinary income comes from. It's from, generating income by working at a business. Now, capital gains comes from an asset or an investment. So if you buy a stock, the stock price goes up, that's capital gains. If you buy a piece of real estate or a piece of land and the price of that land goes up and you sell it at a profit, those are capital gains. So capital gains are made by selling investments for profits. Ordinary income is working as a basic B, basic business person in a job. Okay, so now to further complicate this, there are other legal forms of business. So we have the limited partnership, we have the S corporation, the limited liability company, and the limited liability partnership. So what these companies try to do is they try to solve that problem of liability. So regular partnership, regular sole proprietorship, you have unlimited liability. So when you have a limited partner, he may be shielded from liabilities. An S corporation is sort of like a corporation light. So you can have a corporation that's designed to work with a small business, but have the protection of that liability protection, but maybe also have the protection of not double taxation. So limited liability company, again, is another spin on, or limited liability partnership is another way of trying to limit the exposure to liabilities. So think of it like this. We have the three big forms, sole proprietorship, partnership, corporation, but then we have all these gray areas in between with the law trying to come up with new forms of business that would be a little bit more tailored to individual people's businesses. So depending on what your business is, you may try to take on other types of limited liability organizations that aren't full corporations, so they're cheaper to start and manage, but they're sort of a hybrid between sole proprietorship and corporation. So they're trying to mix and match some of the best features to make some other forms of organization a little bit more conducive to doing business. Now, let's go back to the agency problems and agency costs that we had talked about earlier. So when shareholders lose out on money based on managers putting in their own interests ahead of the company, this is a problem. So say, for example, your mom, she works as the vice president of a corporation, and you're a dumbbell. You're just terrible. You're what we call an F-up, a fool-up, a fool. You shouldn't be working in any company ever, at any time. But your mom likes you kind of because you're a little funny, or maybe funny looking, funny smelling, I don't know. But she feels bad for you, so she hires you at the company and installs you as the new vice president of human resources, which you then go and start doing a bunch of racist things and sexist things and paying men more than women and doing very controversial things that really get people upset at work. So you can see how that's in the mother's best interest because she got her son or daughter a job making a lot of money as a VP of human resources, but not in the company's best interest because they're wreaking havoc and creating a bunch of potential lawsuits in the company. So it's called nepotism. Some of you may have experienced this firsthand to your own benefit, right? Although, I don't think it's nepotism if you own the business and hire your own family. Ever walk into a business and it's clearly the whole family's working there, right? I saw this a lot in Italy. One summer I worked in Florence and I went into like a restaurant and clearly grandma was in the kitchen, mom was outside taking the orders, dad was at the cash register. The whole family was there. The grandkids, like everybody was working. Different set of rules, I guess, if it's a family-oriented business. But in a corporate level, that's not fair to shareholders. So corporate governance is set up in a way to set some rules, some processes, procedures, and how to operate, control, and regulate the corporation to prevent these agency costs from costing shareholders a lot of valuable money. Now, one thing they can do as far as corporate governance is a way the company decides that would be the fairest way for the company to operate within a set of rules they create, or sort of mechanics or mechanisms they create for make sure that there's checks and balances in the business. So it's not easy for agents to steal or do things that can harm the business. Just like I had a rule at the movie theater: you can't be boyfriend and girlfriend and be ticket seller and ticket taker. This day and age, I would say you can't be boyfriend and boyfriend, or girlfriend and girlfriend, or non-gender, or even family members, because it would have to have some kind of separation. Be ideal if you don't know each other at all, because you don't want that collusion to affect the facilitate the theft of money at a business. Now, ways that some of these mechanics they can install to help encourage proper behavior at a business could be stock options. So they can allow managers some ownership in the company. So now managers become more like owners of the company. So if they do things that isn't in the best interest of the company, it's also not in the best interest of themselves, since they're owners of the company. So sort of trying to make managers part owners so they have more of an owner attitude. It's sort of like if you went into I just know quite clearly some businesses I go into and the owner is making my sandwich or making whatever I'm ordering, they might be a little bit more exacting on the proper proportions I'm going to receive, right? Other places, if someone working there is clearly an employee who don't give, it doesn't have any F's to give, I might say, can you put a little bit more meat on that? Ah, sure. Want some more sour? Here you go. And you get like double the amount you really should be getting. This happened to me at Chipotle once. You know, I was just like, hey, come on now. And they're like, oh, okay, you're cute. Here's some more. And I'm like, all right, this person's deranged, you know, so they think I'm cute. So I got this huge amount of food, and that wasn't really in Chipotle's best interest, because it's very proportional of what should be served as far as spoonfuls. They have a measuring system of what should be done. To make it fair, for the shareholders, you don't want to be, you know. So if that employee was an owner, they wouldn't act like that. It's the same thing, you know, it's a different perspective. So we want to give our employees that perspective so they have that ownership perspective so they don't do things like that. And we can also have restricted stock, shares of stock that are paid out as compensation, but they don't fully vest or transfer into the company until certain conditions are made. So basically, it's sort of like a stock option that will just say, you know, we're going to give you, if you work here for 5 years and do a good job, you'll be invested in 1,000 shares of stock, but you can't touch that until you've been here for 5 years. So it's sort of like promises of future stock at an attractive price. Now, as far as investors, we have what's called activist investors. These are investors who may try to influence management, who may threaten the takeover. So their corporate governance has to deal with what happens if you know, we have these activist investors, or they're trying to influence the decisions of the companies or facilitate a takeover. Sometimes corporate government mechanisms